There's a storm gathering over the commercial real estate world, and it has a name: the 2026 debt wall. It is this massive, massive challenge that's going to test pretty much every company in the sector. And the big question is, who's going to make it over? And who is going to get absolutely crushed? And this is really where it gets personal. See that real estate company you have in your portfolio? You know, the one paying out that really nice, juicy dividend every single month? Well, it might just be a zombie. It looks alive, but functionally, it's already dead, and it's walking straight towards a cliff. So just to give you an idea of the scale we're talking about here, between 2025 and 2026, we're looking at an estimated $1.8 trillion in commercial real estate debt coming due. Now think about this. These loans were made back when interest rates were basically zero. But now, they have to be refinanced in a world with way higher rates. It's a seismic shift, and believe me, not everyone is ready for it. So how do you protect yourself, right? How can you tell the healthy companies from the undead? Well, that's exactly what we're going to break down in this explainer. Think of it like this. We're going on a zombie hunt, and I'm going to give you the exact checklist you need to spot them. Okay, first things first. We need to understand our enemy. What exactly is a zombie REIT? It's a term that gets thrown around a lot, but the definition is absolutely crucial for everything that comes next. So here's the core idea. A zombie REIT, it looks totally healthy on the surface. It's collecting rent, it's paying out that dividend, and its stock price might even seem pretty stable. But underneath all that, the balance sheet is just rotting away. It's so burdened with debt that it has zero financial strength to survive a shock. And the 2026 debt wall, that is the shock. It's the moment the mask gets ripped off. All right, to find these zombies, we have to become financial detectives. And the crime scene? It's the company's balance sheet. It is full of clues, but only if you know where to look. We're going to focus on two of the most telling signs. So our first test, it's all about short-term survival. Plain and simple. Can this company meet its obligations over the next 12 months? Luckily, a single, really powerful ratio gives us the answer. And it's called the current ratio. What it does is it measures a company's ability to cover its short-term bills. It does this by comparing its liquid assets, so stuff it can turn into cash within a year, to its short-term liabilities, or what it owes in that same year. Now, the formula could not be simpler. You take the current assets and divide them by the current liabilities. Honestly, just think of it like looking at your own bank account. Do you have enough cash and easily accessible funds to cover your rent, your car payment, your credit card bills for the next year? It's the exact same fundamental question, just for a billion-dollar company. So a healthy REIT, it might have a ratio of, say, 2.0. That means it has $2 in short-term assets for every $1 of short-term debt. Plenty of cushion, right? But a zombie REIT? Oh, its ratio is below 1.0, maybe something like 0.6. And let me tell you, that is a massive red flag. It literally means the company doesn't have enough cash and liquid assets to cover its bills for the next year. It's going to be forced to take on even more debt just to keep the lights on. That, my friends, is a classic zombie death spiral. Okay, on to our second clue. Now this one, it isn't just about what the company says about itself, it's about what the smartest people in the bond market are saying. We're talking about the yield on the company's existing bonds. This is so crucial. A high yield on a company's bond is not a good thing if you're a stock investor. It's a signal of distress. You see, bond investors are really sophisticated. They do deep credit analysis. If they're demanding a super high interest rate to lend money to this company, it's because they see a real risk of not getting paid back. They are skeptical, and that means you should be too. So we've checked the short-term health, and we've listened to what the bond market is screaming. Now we get to the most dangerous part of our investigation, a really brutal timing mismatch that could kill an otherwise decent company. This right here is the brutal truth that so many retail investors miss. They see a REIT's stock price dip and they try to buy it on sale without comparing two incredibly critical timelines. When do the company's leases with its tenants expire, and when do the company's loans with its banks come due? If those two dates are dangerously close, well, you've got a recipe for absolute disaster. Let's just walk through this timeline because it is the very core of this crisis. Imagine a company today, in 2024. Everything's fine. But in 2025, its biggest tenant's lease expires. Maybe it's a B-class office tenant that's downsizing. Who knows? All of a sudden, a huge chunk of that REIT's income just vanishes. Then, just a few months later in 2026, its massive mortgage comes due. I mean, how can it possibly convince a new lender to give it a loan when its income just fell off a cliff? The answer is it can't. This is the income cliff right before the debt wall, and it's a fatal combination. And all of this brings us to the final showdown, the moment of truth. The zombie REIT, it's weak, it's bleeding cash, and now it has to go hat in hand to the bank and ask for a new loan. And that lender, they have one single, non-negotiable test that will decide its fate. At the end of the day, all the stories, all the projections, none of it matters. When it's time to refinance, the lender is laser-focused on one specific number. This is the final boss battle for our REIT. And that number is the debt service coverage ratio, or DSCR. This is like the bank's holy grail. It measures one thing and one thing only. Does the property's income, the actual cash it generates, sufficiently cover the proposed new mortgage payment? From the lender's perspective, it's all about safety. The formula for it is net operating income, which is basically just the property's revenue minus its operating expenses, and you divide that by the total annual debt payments. It's really just a simple comparison of cash in versus cash out for the loan. And here it is, the magic number. Lenders almost universally require a minimum DSCR of 1.20x to 1.25x. What this means is the property has to generate at least 25% more cash than is needed to make the mortgage payment. That 25%, that's the bank's safety cushion. No cushion, no loan. It's that simple. The outcome here is almost always black and white. A healthy property with a DSCR of, say, 1.4x, it sails right through. They get the new loan, no problem. But our zombie REIT, whose income has dropped, comes in with a DSCR of 0.9x. That means its income doesn't even cover the proposed mortgage payment. The result? Denied. And from there, the only options are foreclosure, a painful and expensive emergency injection of new equity, or bankruptcy. Game over. Now, it's true that every crisis creates opportunity. As the zombies fall, the survivors, they emerge stronger. And new players, let's call them the vultures, they enter the game. So let's briefly look at this new landscape before we wrap up. You see, when companies fail their DSCR test, they're forced to sell assets and sell them cheap. This is where healthy companies and these so-called vulture funds swoop in, buying quality properties at a huge discount. We also see this rise of something called preferred equity. That's where new money comes in to save a deal, but on really favorable terms. Basically, they get to jump to the front of the line to get paid, pushing the original owners to the back. It's a brutal but totally necessary part of the market cycle. Okay, let's bring it all home. Here are the 4 questions you need to ask about any REIT in your portfolio. Number 1, what is the current ratio? If it's below 1.0, that's your first big warning sign. 2, how is its debt trading? A high distressed yield is a serious concern. 3, compare the timelines. Do major leases expire right before a big loan is due? That's a critical danger. And 4, the ultimate test. Estimate the DSCR. Can the property's income cover a brand new, higher mortgage payment by at least 1.25 times? If you're seeing red flags on any of these, you might just have a zombie on your hands. So here's the bottom line. The 2026 debt wall isn't just some vague headline. It's a specific set of tests that every single commercial real estate company is going to have to pass. Now you have the tools to see who's prepared and who isn't. So take this checklist, apply it, and ask yourself the hard question. Which of your investments will survive the gauntlet?